Good afternoon, everybody. John Bowens here from Equity Trust Company, broadcasting live from the Equity Trust Company headquarters. Really excited about today's program. It's all question and answers. So I want to thank our avid viewers here who have submitted a number of questions through not only our Facebook Live forums, but also our webinar forums. And I'm going to be drilling down and answering as many questions as I can in a rapid fire session. For those of you that are new, brand new to the concept, Equity Trust Company provides information and education on self-directed IRAs to invest in a wide array of alternative assets, including real estate notes, private equity, venture capital, cryptocurrencies, and a variety of other alternative-based assets. So it's all about creating tax-free and tax-deferred profits. So before I jump into the Q&A, I do want to mention that we have an upcoming webinar. So if you like what you're hearing today, you want to join us for, it's about a 40-minute webinar that we're going to be hosting later this week. Check out in the comments section, register now. In this webinar, we're going to be talking about what we call the 5 self-directed IRA success killers, and ultimately give you an escape hatch, if you will, to avoid these success killers. Included in this is also a number of client stories, so you can actually learn from other Equity Trust clients. In addition to that, if you want more information, more education, more training, check out our YouTube channel. Go to YouTube and search Equity Trust Company. You'll find a variety of videos. I encourage you to subscribe as a Equity Trust subscriber. So that being said, let's go ahead and jump right in to the Q&A. Please keep in mind that Equity Trust Company is a directed custodian, and I'm here to provide education and information, but what I'm not going to be doing is providing tax, legal, or financial advice. So let's go into the first question. This is from our viewer, Dan. Dan asks, what is the impact of purchasing or investing in real estate in a different state than I live in? Do I have to pay other fees outside of annual taxes that would come out of an escrow? So it sounds like what Dan's asking there is other than property taxes. So it's important to understand that if you're using a self-directed IRA to invest in real estate, it doesn't necessarily matter whether you're investing in your own backyard or you're investing in another state. All of the same rules apply, so to speak. Your IRA would acquire the property, your IRA would be responsible for paying for all fix-up and repairs, and you would direct Equity Trust as your custodian to send funds out for those particular expenses. So taxes, insurance, all carrying costs, upkeep of the property, repairs, improvements, all would be paid for from the self-directed IRA. So the best way to think of it is IRA buys the property, IRA pays for all fix-up and repairs, IRA receives all profits. And of course, the advantage of using a self-directed account for most folks is the tax-efficient nature. So the profits flowing back into the IRA in a tax-free or tax-deferred fashion. Okay, question number 2. This is Quada and Scott. Can I use half my personal cash and half my self-directed IRA to buy and rehab a home, then split the profits between the two without a penalty? So I'm assuming that this is a husband and wife couple. They're looking to partner their IRAs together to acquire a property. And to answer the question, absolutely. It's very common for husband and wives to team up, partner their IRAs together to acquire a property. It is important to understand that you have to do it appropriately. So let me give you an example. Let's say I were to buy a property for $100,000, and my wife and I were going to partner our IRAs together to acquire that $100,000 property. And let's assume that I'm going to put $50,000 in from my IRA, and my wife is going to put $50,000 in from her IRA. So proportionally, that's 50-50. So my wife and I are going to acquire the property as tenants and common owners between our IRAs. The titling would be Equity Trust Company custodian for the benefit of my IRA, undivided interest 50%, and Equity Trust Company custodian FBO, my wife's IRA, undivided interest 50%. So our IRAs partner together to acquire the property, and then going forward, because it's 50-50, all profits and all expenses would flow 50-50. So each time we have an expense that comes up, maybe we have to pay our contractor $10,000 to do some rehab before we sell the property for a profit. So in that instance, $5,000 for the general contractor payment is going to come from my IRA, and $5,000 is going to come from my spouse's IRA. We have additional training and education on this as well. You'll get to learn about the Equity Trust proprietary My Equity technology platform. This enables our investors to simply log online and request payments to be sent from their IRA directly out to their contractors or for any other expenses necessary. So you can check that as well out on your own time. I'm really glad that Quita and Scott asked this question because it's really important to think about how you can partner your IRA with a spouse's IRA or your IRA with maybe a child's covered education savings account. We've even seen investors go upwards of 6 or 7 self-directed accounts all partnering together for one individual transaction. Last but not least, also partnering with non-IRA money. So I have an investor here in Cleveland. His name is Gary. Some of you have seen his case studies before in our other training programs. Gary bought a property for around $41,000. It was a foreclosure house. He bought it for $41,000. He partnered 75% with his Roth IRA and then 25% his LLC, the LLC that he has formed for his real estate transactions. So totally separate from his IRA. So his IRA partnered with his LLC 75-25. Both entities were listed on the deed to the property. Going forward, the repairs were about $30,000. 75% of all the repairs paid for from his IRA and 25% from his LLC. So his IRA and his LLC were both writing checks to the contractors. He sold the property and he made approximately $36,000 in profit and about $25,000, about $26,000 in fact, profit went back into his Roth IRA, tax-free of course, because it's in his Roth IRA. The remaining amount went to his taxable savings. So great question, Quita and Scott. I'm glad you brought it up because partnering multiple IRAs can be a very beneficial strategy depending on the situation for the investor. Okay, related question there. If I purchase a fix and flip house with my personal cash, can I use my self-directed IRA to fund the rehab? So you could not, to answer the question in short, Rick, you cannot buy a property personally and then have your IRA come in and rehab the house. That would be considered a prohibited transaction. Really important to understand that you can't do that. In fact, in the webinar that I mentioned before, so you can check out the video webinar in the comments section, register for the webinar. Seats are filling up fast. It's a free webinar, so check out the content. In the webinar, we talk all about rules and who you cannot transact business with. So it's important to understand, Rick, that you are a disqualified person to your IRA. Therefore, it would be a prohibited transaction for your IRA to buy a house and then you personally to come in and pay for the rehab. In the webinar, we dive a little bit deeper into who disqualified persons are and what prohibited transactions are. All right, moving on to Danielle and Monica. They asked a question about borrowing from an IRA. Can I pay myself interest on my borrowed money from my equity trust account? Can I borrow against property owned in my IRA? So the first thing to understand is that with your IRA, you cannot loan money to yourself personally or an LLC or other entity that you are an owner of. That's what's called a prohibited transaction. And we will dive again deeper into that into the webinar later this week. When you buy property with your IRA, keep in mind that your IRA is not lending you money, and therefore you have to pay that money back. You're not borrowing against the account like you could borrow against a 401k. A lot of people get caught up in this whole concept of borrowing against the 401k. We're not borrowing against our 401ks or IRAs here. What we're doing is we're taking our IRA money and we're buying a property. The IRA is going to take title of the property. And then all profits go back into the retirement account. So in short, for Daniel and Monica, you cannot borrow against your IRA. Your IRA would actually go out and acquire the property. Second part of that question is, can I borrow against a property owned in my IRA? It is possible to get what's called a non-recourse loan. So theoretically, if you own a rental property in your IRA, you could potentially go to a non-recourse lender. It has to be a non-recourse lender. You could potentially go to a non-recourse lender and do a cash-out refinance and then use that cash to buy another rental property in your IRA. But you couldn't take a property in your IRA, do a cash-out refinance, and then use that personal money to go out and personally buy a property. That would be going back to a prohibited transaction. All right, so Corinne is our next question that we have. She asked, if I want to purchase real estate at an auction, how do I get a check from Equity Trust prior to the auction? Do the funds come out of your account at the time, or is there a charge to your balance? So there are a number of questions around buying properties at an auction. It is possible to buy properties at an auction depending on the type of auction that you're acquiring those properties through with your Equity Trust IRA. To give you one example, I have a client here, 2 clients in fact, that have bought a number of properties through foreclosure auctions. And what they do is ahead of time, they request a check from their Equity Trust account. And typically that's a $5,000 check that they request from their Equity Trust account. They go to the auction, the foreclosure auction. If they're the winning bidder, they give the check to the auctioneer to deposit. And then they have between 5 to 7 to sometimes upwards of 10 days to remit the remaining balance. And then they simply just log into their account online, that My Equity system I mentioned before, the technology platform, and they request the additional amount to be sent to the county auctioneer. So there are ways, in fact, to acquire properties through foreclosure auctions by requesting funds ahead of time from Equity Trust. The second part of the question, if you don't use the money, you would simply mail the check back to Equity Trust. You would write on the back, not used for purpose intended, and then that money would be, of course, placed back into the account. So in other words, the money was released, but then it was replaced into the self-directed IRA. There's a lot of other ways in which you can negotiate or manage buying properties at auctions. I have another client here who uses a third party. He has a third party that goes to the auction, the third party does the bidding, and then his IRA is writing a check to that third party in order to procure the properties through the auctions. And then you may also look into setting up some sort of entity like an LLC or a trust in order to then flow the money through that particular entity in a bank account where you could readily access money at a moment's notice. It is important to understand with that more advanced structure, typically requires a third-party manager to operate in the capacity. You need to get with an attorney, and of course, to form the entity, and of course, make sure that that is a sound and proper structure for your particular situation. So, short answer is you can buy properties through auctions with your IRA. It's just a matter of determining what auction are you buying them through, and ultimately, how are you going to do that? All right, next question I hear a lot is, how do I find good investment properties or deals? And this really goes back to the very beginning when I mentioned that Equity Trust is a directed custodian. So we can't give you tax or legal or financial advice. So we can't really tell you where or how to find good deals. What I could mention is that Equity Trust Company here, as a directed custodian, when you find a deal or find a transaction, you can reach out to Equity Trust Company and you could say, hey, I'm looking to buy a property with my self-directed IRA. Can you teach me about how this works with a self-directed IRA? And we could certainly provide some information on how that works with a self-directed IRA, how our technology platform works, how you can quickly get an earnest money deposit from the IRA sent out to secure the property acquisition. So we can go through all of those nuts and bolts with you. All right, next question is Gail. Who can I rent to if I use a self-directed IRA for an investment property? Who can I rent to? All right, so in the webinar, to get registered, again, check out the comments section. In the webinar, we talk about who disqualified persons are and what are prohibited transactions. So if a disqualified person does a transaction with an IRA, it can be considered a prohibited transaction. Disqualified persons, we always say, are people up and down the family tree. So think you to your IRA, your spouse, any business entity that you own or are affiliated with, your children, your grandchildren, your parents, your grandparents. Those are considered disqualified persons to your IRA. And so you couldn't rent a property that you own in your IRA to those particular individuals. So I couldn't buy a property with my IRA and rent it to a son or daughter. I couldn't buy a property with my IRA and lease it to my business that I'm running a landscaping business through or something of that nature. Those would be considered prohibited transactions. In my experience, I don't find a lot of investors have issues with this because their idea of using their self-directed IRA is to create and preserve wealth. And so what they want to do is buy properties and lease those properties to third parties. They want to rent them out and have cash flow coming in tax-free or tax-deferred. They're not trying to self-deal or commingle their funds. All right, next question, Matt. If someone owns real estate in a self-directed IRA, how do they take required minimum distributions? Well, thank you so much, Matt, for bringing this question up. So first, what is a required minimum distribution? Well, with traditional IRAs, and this doesn't go for Roth IRAs for an account holder, but traditional IRAs and other tax-deferred accounts have what's called a required minimum distribution, RMD for short. And what this is the government says starting at 70.5 for certain retirement plans, you have to start taking some distributions from the account. And it's based off of your life expectancy. And so if you go to the IRS website, irs.gov, and you search Uniform Life Expectancy Table, you're going to find the life expectancy table for individuals that need to take distributions from their tax-deferred accounts. Now, to do a quick math lesson for you, if you're 70.5 and you have a $100,000 traditional IRA, that would be assets plus cash value. You take that $100,000 and you're going to divide it by the actuarial table. Starting at 70, it's 27.4. So I do 100,000 divided by 27.4, and that's going to come out to about 3.6% of my total principal balance of my account, or in other words, about $3,600. So why am I giving you this quick math lesson? Not that I expect you to follow along with the entire math lesson. You could do a search online and find this information very quickly. The reason why I'm telling you this is, think about it. With a $100,000 account, I only have to distribute at 70.5 about $3,600. So the assumption would be made is that I have enough cash flow coming in order to satisfy those required minimum distributions. See, it's really important that we understand the mathematics behind this. Because, see, I have found in my experience, investors will come to me or to us and they'll say, John, I can't self-direct my retirement account into real estate because of RMDs. Coincidentally, a lot of times I ask them what their age is, and they're usually about 20 to 25 years before 70.5. So ultimately, it doesn't really make a difference anyways. They have many, many years in order to determine how they're going to negotiate this. But if you are getting close to 70.5, it's important to understand that required minimum distribution, it doesn't say you got to take all your money out. It just says that you have to take a fraction of it out. So if you have enough cash flow coming in, you should be able to satisfy the required minimum distributions even if you have properties or notes or other alternative assets. Lastly, if you don't have any cash in the account, conceivably you could distribute an entire asset. You could distribute a fraction of the asset in order to satisfy your required minimum distributions. Of course, we would always encourage you to maybe speak with a CPA or an accountant regarding those RMD, required minimum distribution calculations, and how they operate. All right, great question though, Matt. Thank you. Another question that I get, last but not least, as we start to close up here, and feel free to, by the way, ask more questions in the comment section, and we will try to answer as many questions as we possibly can on future broadcasts. But another question that I get quite frequently is, what are some common obstacles to self-directed real estate investing? Okay, real estate investing specifically. So for those that are looking to fix and flip or buy and hold real estate with their IRA, what are some of the common obstacles? So I've broken it down to 5 obstacles or barriers. And in our upcoming webinar that I mentioned, the 5 success killers, that's what it's all about. It's all about talking about these barriers or obstacles and ultimately how to avoid them or how to overcome them. So I'd encourage you to get registered for that webinar so you can get a little bit deeper dive of this. But a couple things that I think are noteworthy here. Number one, not having enough information or education. So one of the questions that we had in here was about partnering multiple IRAs together. A lot of people don't understand how that works and how to take advantage of it. In fact, I spent this entire weekend in Milwaukee teaching a class of about 50 folks how to partner multiple IRAs together to do deals. And most of the people in that group didn't understand it, didn't have any idea that they could even do that. And when they walked away from this, they had a powerful mechanism in order to be able to go out and buy more real estate going forward. If you're interested, by the way, in one of our live training events, you can go to iraevents.com. We host one-day workshops all across the country. So that would be the first one, is that folks just don't necessarily understand the process and they don't understand what the opportunities are. There's a ton of opportunity out there. We just have to learn and educate ourselves on what that opportunity is. The other thing is the rules. All right, so a lot of people get caught up in the rules. I mentioned, and I was a little bit sarcastic there with required minimum distributions, but that's true. I can't tell you how many people are actually not moving forward investing in real estate with a self-directed IRA because they're worried about required minimum distributions. And 9 out of 10 people that I talk to that are worried about that are 20, 25 years away from 70.5. And again, it's only 3.6%. So it's important to have the facts straight in order to make a good financial decision going forward. And so understanding the rules. In the webinar, we're going to talk about those disqualified persons. We're going to talk about prohibited transactions. So you have a clear understanding of what they are and what they aren't. Last but not least, I'll mention in terms of what other questions folks have is what are the options in terms of investing with a self-directed IRA in alternative assets? Well, the options are really unlimited. There's only a few things that you can't do, and we'll talk about some of those in the webinar. But ultimately, you can invest in just about anything with a self-directed IRA. Real estate is a big focus, is a focus of this live session that we're talking about here. Flipping houses, buying rentals, buying on subject to, buying on lease options, selling on lease options, seller financing, land contracts, lending money secured by real estate. So if you're somebody that's looking to be a private lender secured by real estate, that's an option as well. And then outside of real estate, cryptocurrencies, known as digital currencies here at Equity Trust, investing even in stocks, bonds, and mutual funds. You still have the capability of doing that with a self-directed account. You're really not limited. You're not going to be limited to only investing in certain asset classes. So Equity Trust is an alternative asset custodian that allows you to go well beyond just stocks, bonds, and mutual funds. If you guys like this Facebook Live session, if you got a lot out of it, if we were able to answer a lot of your questions, like us, share us, check out our YouTube videos, as I mentioned earlier. Make sure to register for the webinar. Keep asking your questions. I will keep answering as many questions as I can. As you can tell, I'm incredibly passionate about education and information. Although I can't give tax, legal, or financial advice, I can certainly provide a lot of education and information so that you can get to work on directing your own self-directed IRA, creating more wealth, and preserving more wealth. Register for the webinar. We look forward to seeing you on the call. We look forward to seeing you on the next Facebook Live session.